Welcome back to the Deep Dive. This is the weekly Markets Digest from Generating Alpha. We're here to help you cut through the noise and understand what really moved the markets in the week ending November 7th, 2025, and what's on the radar for the week ahead.
Absolutely. And this past week, the big theme really was this global risk-off feeling. A lot of skepticism, particularly around those, sky-high AI valuations.
Yeah, definitely felt like a shift. We'll dig into that, plus some key earnings reports that really highlight this tension between growth and cost.
But first things first, we have that mandatory bit to cover.
Right, you are. Okay, here we go. This podcast is for entertainment and education purposes only, and in no way does it constitute individual investment advice. It is curated by humans, presented by AI, and proudly sponsored by The Compounding Machine, thecompoundingmachine.substack.com.
Okay, great. With that done, let's dive straight into the U.S. markets. Like I said, the main story was this. Well, this pause for breath, especially for tech and AI stocks.
Applause is putting it mildly. U.S. stocks actually snapped a 3-week winning streak. The NASDAQ composite, the tech-heavy one, it led the way down sharply.
Yeah, it was quite the reversal.
So for you listening, what really stands out about how bad this tech sell-off was?
I think the key thing to look at is the growth versus value gap. The Russell 1000 Growth Index, it underperformed its value counterpart by 288 basis points.
Wow, okay, 2.88%.
Exactly. And that's the biggest gap we've seen since way back in February. It strongly suggests investors were actively moving money out of those expensive growth names.
And into, what, safer, cheaper value stocks?
Precisely. A classic risk-off rotation.
So you had tech selling off on valuation fears, but wasn't there also just some gloomy economic data weighing on everything?
Oh, definitely. It felt like a perfect storm almost. You had the ongoing worries about the U.S. federal government shutdown still lingering.
Right, that was cited as a big reason for consumer confidence dropping.
Yep. The University of Michigan index took a nosedive, down to 50.3. That's the lowest it's been since June 2022.
Ouch. And inflation expectations didn't help either.
No, they actually ticked up a bit to 4.7%. So confidence down, inflation worries up. Not a great combo.
And then you layer on that shocking jobs data.
Yeah, the Challenger, Gray, and Christmas report. October saw, get this, 153,074 job cuts announced.
Whoa.
That's the most for an October since 2003. And it pushes the year-to-date cuts up 65% compared to last year.
So let's connect the dots for everyone. Job cuts are soaring. People feel terrible about the economy, but they still expect higher inflation.
It's that nasty mix, isn't it? It screams market jitters about potential stagflation. And the result? A flight to safety.
Which we saw clearly in the bond market, right?
Yeah.
Treasuries did well.
They did. Positive returns as money looked for a safe haven. And conversely, riskier stuff like high-yield bonds.
Took a hit.
Big time. They underperformed significantly, reflecting that broader risk-off mood, driven by the equity weakness and that unsettling economic backdrop.
Okay, let's pivot. Across the pond to Europe, did they import those same AI valuation worries?
It looks like it. The pan-European StoXX Europe 600 index fell 1.24%. Very similar pressure to what U.S. tech faced.
But the big news over there was the Bank of England, wasn't it?
Absolutely. All eyes were on the BOE. They held the key rate steady at 4.0%, but importantly, it was a close call, a 5-4 vote.
So divisions showing within the committee.
Seems that way. It suggests the debate about what to do next is really heating up, and Governor Bailey's comments afterwards.
He sort of gave the market what it wanted, right? Hinting at cuts.
He definitely fueled expectations for a rate cut maybe as soon as December. He said a 3.5% terminal rate was a fair description. That gives the market a clear signal to price in.
Meanwhile, the Eurozone economy itself still looks a bit shaky.
Yeah, still soft. Retail sales in the Eurozone fell again in September, down 0.1%. That's the third month in a row. And while German industrial output had a bit of a bounce, up 1.3% month on month, the overall trend there is still described as, well, weak.
Okay, let's keep moving east. Japan, following the global trend too.
Yep, markets down there as well. The Nikkei 225 dropped quite a bit, 4.07%. Investors basically taking profits after those big AI-driven runs pushed things to record highs recently.
Makes sense. And the yen.
The yen actually got stronger against the U.S. dollar. It benefited from some of those risk-off flows we talked about.
Domestically, though, Japan's got that ongoing issue with wages, doesn't it?
It really does. Nominal wages, so the headline number, grew 1.9% year over year, which sounds okay, right?
Inflation.
Exactly. Inflation is running hotter than that. So real wages, what people can actually buy, fell for the 9th month in a row, down 1.4%.
That's tough. No wonder the new PM's pushing for stimulus.
Yeah, PM Takaichi is pushing hard for a fiscal spending package. They really need to boost consumer spending power somehow.
Now, China seemed to buck the trend this week. Mainland markets were actually up slightly.
They were, yeah. The CSI 300 gained 0.82%. Shanghai Composite up just over 1%. A bit of an anomaly compared to elsewhere.
What was behind that little rally?
It seems mostly driven by a bit of a thaw in U.S.-China relations. News about easing trade tensions, talk of a one-year truce discussed at the APEC summit.
APEC, that's the Asia-Pacific Economic Cooperation Forum.
That's the one. So that news gave a short-term boost to sentiment, but, analysts are quick to caution that the long-term strategic rivalry is still very much the main story there.
Okay, that sets the global scene really well. Now let's dive into those earnings reports. Because if the market's worried about AI cost and valuations, these next few companies are just perfect examples.
Right. Let's kick off with the one everyone watches for AI hype, Palantir, ticker PLTR.
And they delivered, didn't they? A big beat for Q3 2025.
An undeniable beat. EPS came in at 0.21 cents. Revenue was $1.18 billion. That revenue number is up an incredible 63% year over year.
63%. Wow. And that U.S. commercial revenue?
Just exploded, up 121%. Massive surge there.
CEO Alex Karp wasn't exactly modest about it either, calling it arguably the best result any software company's ever delivered.
He certainly wasn't. And they boosted their full-year revenue guidance pretty significantly, too, up to nearly $4.4 billion. Adjusted operating margin also hit a record 51%.
Okay, stellar numbers, great guidance, record margins. So why on earth did the stock initially drop over 7% in pre-market trading? That seems crazy.
It's the paradox, isn't it? When your stock trades at a price-to-earnings ratio of over 380.
380?
Yeah. The market isn't just expecting growth. It's expecting perfection, sustained, maybe even accelerating. So even with fantastic results, any whiff of analyst skepticism about whether that valuation is sustainable just triggers selling.
So it wasn't about Palantir failing. It was about the market just saying this price is too high, even now.
Pretty much. The bar is just incredibly, incredibly high at that kind of valuation.
Okay, now let's look at AMD, Advanced Micro Devices, another AI play, but maybe a slightly different angle on this cost issue.
Yeah, AMD also had a strong report. Q3 revenue was $9.25 billion, EPS $1.20. Both beat forecasts, definitely riding that AI wave.
And the data center segment, that's where the AI chips are, that looked really strong.
Very strong. Revenue there jumped 22% to $4.3 billion. Client and gaming were also up nicely year over year.
And their Q4 guidance looked decent too, right? Above what people were expecting.
It did. They guided for revenue around $9.6 billion, plus or minus $300 million. And this is the crucial point, profitability in that booming data center division actually fell.
Fell, despite revenue surging. How?
Down 14%. And it's not because sales were bad, it's because the costs are enormous. The cost of ramping up production of these super advanced chips, plus the sheer amount they have to pour into R&D just to keep up in the AI race.
So they're spending massively now to compete later.
Exactly. It's a long-term strategic necessity, fighting NVIDIA and others. But the market sees that immediate hit to margins, and it has to digest that trade-off. Growth now, but at what cost to profit?
That exact dynamic, spending big on tech now, hitting profits, now showed up somewhere unexpected too, didn't it? Over in the UK with Rightmove.
Oh yeah, Rightmove. The big UK property portal, ticker RMV. Their shares absolutely cratered. Down over 25% after they cut their profit forecast for 2026.
25%. Just from a forecast cut. What was the reason?
AI investment. Pure and simple. They specifically announced they're ramping up spending on AI and future tech, and the key here is how they're accounting for it.
Okay, explain that.
They flagged £12 million in what they called P&L investment. That means it hits the profit and loss statement directly, immediately impacting reported profit. They also have another £6 million in capitalized spending, which gets spread out.
Ah, so that £12 million is the killer for near-term profit.
Precisely. It's a direct, immediate margin hit. So even though the revenue growth forecast for 2026 remained pretty healthy, 8 to 10%, their underlying operating profit growth forecast got slashed to just 3 to 5%.
Wow, that's a big cut from the revenue growth.
It is. It represents about a 4 to 6% downgrade compared to what analysts were expecting, and it's purely because of that AI investment.
So the message is, AI isn't just nice to have anymore, it's a mandatory cost, even if it hammers your profits in the short term.
That seems to be the takeaway, especially if you want to stay dominant like Rightmove. It completely resets how investors have to think about these established digital platform businesses.
Interesting contrast then with AutoTrader, AUTOA, the UK car marketplace, their update seemed much more steady.
Much steadier. AutoTrader's first half results for 2025 showed revenue up 5%, operating profit up 6%. Solid, steady growth.
And they're still dominant in their space.
Hugely dominant. They still command over 75% of all the time people spend looking at cars online in the UK. And they are investing in AI too. They mentioned a new generative AI tool called Co-Driver that over 10,000 retailers are already using.
But it's not causing the same margin shock as at Rightmove.
Apparently not. Maybe their investments are structured differently, or maybe their core business is just better able to absorb those costs right now without that dramatic profit hit. Their full-year outlook is unchanged, and they're still returning cash to shareholders via dividends and buybacks.
So investors are clearly differentiating. They see Rightmove making a potentially painful but necessary pivot, while AutoTrader is maybe integrating AI more smoothly into its already strong position.
It really highlights that distinction, yeah. How is the AI investment impacting the immediate bottom line? That seems to be the critical question investors are asking right now.
Okay, let's shift gears and look ahead. The week of November 10th to the 14th, what are the key data points you'll be watching?
It's a busy one, especially for the UK. On Tuesday, we get crucial numbers on the unemployment rate and, importantly, wage earnings.
Right, vital after that BOE meeting.
Definitely. Then Thursday is huge for the UK. The Bank of England interest rate decision itself, followed by the first look at Q3 GDP data, a major check on the economy's health.
And in the U.S., inflation is back in focus.
Yes. Thursday brings the big one, CPI and core CPI for October. After the recent jobs data and confidence numbers, any signs of sticky inflation there could really rattle markets.
Okay, what about the euro area in China?
For the Eurozone, we get the ZEW Economic Sentiment Index on Tuesday, giving a read on investor mood, and then the second estimate of Q3 GDP on Friday. And China wraps things up on Friday with industrial production and retail sales for October, always important for gauging their domestic economy.
Now, we usually finish this section with the CNN Fear and Greed Index. We look at it for a sentiment check.
Right, we do. Although for this particular deep dive, the specific latest reading wasn't available in the source material we had access to.
Okay, so no exact number this week. But based on everything we've just discussed, the market action kind of tells the story anyway, doesn't it?
I think it does, yeah. You don't really need a number to see the shift. The market's clearly moved away from just blind greed for anything with an AI label. Now it feels much more like skepticism, maybe even bordering on fear for some names.
It's definitely become more selective.
Highly selective, punishing Palantir for its valuation, even with great results. And at the same time, punishing Rightmove for making the investments probably needed to survive the AI transition. It's a tough environment.
Which brings us nicely to our final thought for you to chew on this week. We've talked about AMD, Palantir, Rightmove, totally different sectors, right?
Completely different. Tech hardware, software, UK property.
But all making these huge upfront investments in AI. Spending now, often hitting margins now for future gain.
It seems universal, this commitment to aggressive AI spending, the CapEx involved, and it fundamentally changes things for investors.
So the question is, are we entering a phase, maybe the next 12, 18 months, where the market actually starts to ignore short-term profits? Where the companies rewarded are the ones who sacrifice margins today to build that AI mode for tomorrow?
It's a fascinating question because the margin pain is real. You see it in AMD's data center division. You see it in Rightmove's guidance. But the need to invest also feels real, almost existential for some companies.
So how do you measure success now? Is it today's earnings per share? Or is it the demonstrated commitment, the CapEx, that shows you're serious about winning the next decade of tech advantage?
It might shift the focus for growth investors. It's not just about top-line growth anymore. Maybe it's about that CapEx commitment. Who is spending serious money to secure their future? That could be the new metric the market focuses on.
Something to definitely think about. That's all the time we have for this weekly Markets Digest deep dive from Generating Alpha. Thanks for tuning in.
And a big thank you to our sponsor, The Compounding Machine. You can find them at thecompoundmachine.substack.com.
We'll be back next week to break down the latest market moves for you. See you then.